There's a couple of key reasons why the stock market has been doing what it's been doing lately. It's risen sharply multiple times, and it's also pulled back hard and sharp a couple key times. All this in the past couple of days. Time to prepare for a new stock market. I'm gonna go over the top 3 things that has just happened in the last week or so, and that you absolutely need to understand. In order to invest intelligently, you need to be well informed, and so in this video, I'm gonna be going over Trump's big beautiful bill. I'm going to talk about the recent craziness in the bond market and Trump considering privatizing Fannie Mae and Freddie Mac. I'm going to give you all the highlights and some pros and cons of all of this and what to expect, but I also respect your time, and so this is going to be all facts, no fluff. Let's get right to it. My name is Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. So let's start with Trump's BBB budget, or the Big Beautiful Bill. President Trump's proposed One Big Beautiful Bill Act is projected to add over $3 trillion to the national debt over the next decade, pushing the debt to GDP ratio to a record 125%. There's 4 quick things that I'm going to outline from this bill, and then I'm going to give you the outlook as far as what we can expect moving forward. The first one is tax policy. This bill permanently extends 2017 Trump tax cuts, including corporate and individual rate reductions. It introduces new tax incentives for US-based manufacturing and fossil fuels, and projected to cost over $3 trillion in lost revenue over 10 years. Number 2 is the spending priorities. Major boost to defense spending, especially in cyber, missile defense, and Pacific naval expansion. Significantly expands border security and immigration enforcement funding. This will also reduce or eliminate funding for climate and renewable energy programs, diversity and equity initiatives, arts, humanities, and public broadcasting. Number 3 is all about the social programs. This is going to impose work requirements for Medicaid, SNAP, and Section 8 housing. Proposes block granting Medicaid, capping federal contributions, and it cuts education grants and student loan subsidies. And number 4 is the fiscal outlook. This could increase the national debt by an estimated $3.1 to $3.5 trillion over 10 years. The debt to GDP ratio is projected to exceed 125% by 2035, and interest on debt is projected to surpass spending on Medicare and defense by 2030. So what's next? What should we look out for or expect? Within the next 2 to 4 weeks, we're going to have some Senate budget hearings. Possibly by the summer or end of summer of 2025, we'll have the Senate floor debate and vote. By November of 2025, the election impact could shift the power, and late 2025 or early 2026 could be the final law if passed. We'll see what happens, but if you like this style of video, let me know down in the comment section below. I might start doing this a little bit more often and just give you the highlights of what's happening and why the market's either up or down in a very quick format. All in all, from what I can read from this big beautiful bill, some of it could make the market go up short term, especially the things like taking away taxes. But long term, that national debt is just not good. And speaking of debt, this brings us to our big thing that's happened in number 2. And this is all about that bond market volatility. Investors were reacting to the fiscal implications of the new tax bill, leading to a sell-off in long-term US Treasury bonds. Yields on 10 and 30-year notes have risen sharply, potentially increasing borrowing costs across the economy. Moody's recent downgrade of the US credit rating has further fueled these concerns. Obviously, the fact that Moody's did cut down that credit rating was not positive. When Moody's or another agency cuts a country's credit rating, it signals that lending to that country has become riskier. This shoots the long-term bond yield up because they need to entice people to believe in the long-term health of the US. When the long-term bond yield shoots up, usually the stock market has an inverse relationship, and so right here on the S&P 500 chart, you can see the drop. As soon as the bond market rose, the entire stock market crashed. And earlier this week, as soon as it happened, I went straight to my private Patreon group and let them know so they wouldn't freak out. Like I said at the beginning of this video, the more informed you are as an investor, the better decisions you're likely going to make and hopefully more money you're going to make. It's only $20 per month to be a part of the group, and you have access to direct message me at any time and to chat with the rest of the members whenever you'd like. Click the link down below after this video. Now those two things were already big enough, and that's a lot to handle in a week, but we have one more super huge thing, and it's all about housing. So number 3 is that Trump is considering privatizing Fannie Mae and Freddie Mac. President Trump announced he's very seriously considering taking Fannie Mae and Freddie Mac public. So I'm going to give you some pros of this, some cons of this, and ultimately what this means for us as investors. So some pros of privatizing Fannie Mae and Freddie Mac would be number 1, it reduces the government role in housing. Privatization would reduce the federal government's footprint in the mortgage market, and it could signal a move toward a more market-driven housing finance system. Secondly, there's the potential for taxpayer risk reduction. It shifts the financial risk from taxpayers to private investors. In theory, the private market would absorb future losses from mortgage defaults rather than relying on a government bailout. Third, there would be increased market efficiency. Private entities might respond more efficiently to market forces and innovate more quickly. This could foster greater competition if other players enter the market. And the last pro might be that there's a windfall for investors. Existing shareholders of Fannie and Freddie, especially hedge funds and institutional investors, could benefit substantially if the companies are successfully re-IPO'd. Now there's some obvious cons if this goes into effect as well. First would be higher mortgage rates. Without an implicit government guarantee, investors would demand higher returns, which could lead to higher mortgage rates for homebuyers. Secondly, there would be reduced access to credit. Third, there's obviously systemic risk concerns. Fannie and Freddie play a central role in the mortgage ecosystem. If privatized without sufficient regulation or capital buffers, their failure could pose significant systemic risks. There's also political and legal complexities. Privatization would require navigating complex legal, regulatory, and political hurdles. And lastly, of course, there's going to be market shock potential. The transition could spook investors, destabilize the mortgage-backed securities market, or lead to credit tightening if not carefully managed. If Fannie Mae and Freddie Mac were privatized, the impact on home prices would largely depend on how the privatization is implemented and how the markets respond. Here's a breakdown of the likely projections based on economic modeling and expert consensus. Within the first 1 to 2 years after privatization, the mortgage rates could rise by 0.3 to 0.7 percentage points due to the loss of an implicit government guarantee. Higher borrowing costs reduce purchasing power, especially among first-time and lower-income buyers. This could lead to a 2 to 5% decline in home prices, depending on the region and market conditions. Demand may cool more sharply in price-sensitive areas. In the midterm, like 3 to 5 years post-privatization, prices may stabilize once the market adjusts to the new risk-based pricing and credit standards. Homeownership may decline slightly, but rental demand could increase, putting upward pressure on rents. Institutional investors may move in to fill financing gaps, but also demand stricter terms or higher down payments. In the long term, so 5 to 10 years after, the high-income, low-risk buyers may face little change, but marginalized borrowers could be priced out or pushed into subprime-type products. This could create a two-tier housing market where desirable urban and suburban areas recover faster while lower-income or rural areas stagnate. If private entities optimize underwriting, some innovation may return to the market, potentially rebounding demand and prices over the long term. But this would require careful regulation to avoid another bubble. So whether you're looking to invest in stocks or in real estate or whatever it is that you're looking to invest in, understanding all of this and why it's happening and what it could do in the future is so important. I'll keep you informed with more of these style videos if it's something that you like, so make sure and comment down below, and I'll see you over in the Patreon. And in the meantime, check out either of these two videos. And as always, remember to keep investing simplified.